So I guess people are actually starting to join now, and it's 10 o'clock. So I guess let's go ahead and get started.
Awesome.
I'll introduce myself. My name's Jordan Pence, president of Advisors Resource Company. We have Madeline Nelson here. She is our director of marketing. She put together this. I guess we could call it a podcast. We got to
We
think
can
of a
call it a
better. We got
podcast.
to think of a
We
better
can, if
name.
you're listening to it.
But anyways, we're diving into life insurance retirement plans, or LIRPS. You know, the industry loves acronyms and abbreviating those acronyms so nobody knows what you're talking about.
Yeah.
But this is really a powerful but possibly overlooked strategy, and we're going to dive into that today. So
Yeah, great. And hey, one quick thing before we get into it. If you're listening to this after the fact and you want to be part of the live situation, the invite is always on our website. So you can always sign up there if you want to ask your own questions at the end. So
thanks, Manny.
yeah.
That's exactly right.
So with that, can you just kind of line out the basics of LIRP, like what it is and like how does it work?
It's a great question. Life insurance retirement plan, as I would define it, is basically an overfunded insurance policy. And overfunded, I guess, is again some more jargon, of course.
Yeah.
But really what you're doing is you're putting in as much as you can into the policy. And these types of policy that we're utilizing is typically a universal life policy. So it has flexible premiums, and really what that means is the client can basically pay whatever they want. I mean, that sort of gets lost in confusion, but we fund it to where they're putting the most amount that they're allowed to based on essentially IRS guidelines. And we're funding it in that level so that it builds up cash value. So really, I guess you're building up cash value inside the policy that you can later on take out with no tax consequences.
Okay.
So really, it's acting sort of like a Roth IRA with some additional benefits and obviously some pretty large differences.
So, I mean, leading into that, what kind of are the differences and why might someone choose a LIRP over, like what you said, a 401k or IRA?
It's a really good question. Again, I mean, a 401k or an IRA is sort of maybe a different thing, but still a good option. I mean, I'm not saying any of these things are bad or good or indifferent.
Right, just different for different people.
Right. And
Okay.
everybody should have everything, right? So
Oh.
everybody maybe should have all of these things, right?
Yeah, sure.
So, but it's a great question. I mean,
Make the most money you can, of course.
So the big difference is the distributions are not taxable in the insurance. With the insurance, you can access the money before 59 and a half without paying a 10% penalty.
And that's how it is with the 401k?
Well, yeah, so
Okay, I'm not really super familiar.
It's a good question. So if you have money in your 401k and you're younger than 59 and a half, regardless, well, I guess I shouldn't say that, but if you have it in a 401k or a qualified plan and you take a distribution, you pay ordinary income taxes on that, and then you may also pay a 10% penalty if you're younger than 59 and a half.
I gotcha.
So there's some, I mean, downsides might be a strong word, but furthermore, with regard to the life insurance, specifically for people who are earning more, have higher incomes and so forth, the savings in the 401k or IRA or whatever they have may not be enough for the type of lifestyle that they want in retirement. So for example, those qualified plans have contribution limits.
Right.
Whereas if you did an insurance policy, we can set it up to where the maximum premium is theoretically unlimited. So they could put in whatever they want. Furthermore, unlike some qualified plans like traditional IRAs and traditional 401ks, insurance wouldn't have required minimum distributions. So,
oh, really? No
yes.
minimum? You can just.
Well, what I mean by that is, if you have money in an IRA, when you reach 73 now, you have to take money out of that.
Oh, like it can't be like a death benefit for your kids, like
Yeah, you can't just leave the money in there forever and not do anything not do anything for it.
Yeah, and hey, don't mean to interrupt. I see we have a couple chats. I don't know if you
Oh,
want to address
some
those
questions
while we're on
popping
the
up.
topic. Yeah.
Yeah, and I'll I'll address some of these here in a minute because I said universal life, and this person said, well, using UL, not IUL, and I guess the I in IUL is only referring to how the money grows inside the policy, and that's through the indexes. A UL, whether it's a VUL, IUL, GUL, current assumption UL, whatever, they're all under fundamentally the same thing. They just have different features and cost structures. The final thing that I will say about IUL or index policies versus, like investing in the stock market, right?
Okay.
Is the index policies, they will have a floor. So you won't lose money due to market performance.
Mm.
So if the market goes down by 20% in an IUL, your cash values won't be reduced. Now, obviously there's some sort of cap and so forth. And that can obviously limit some of the growth potentially. But I mean, if you look at a broad picture, there are certain time periods where an IUL is going to overperform the market and the market's going to overperform an IUL. So it's kind of
like a trade-off.
right, exactly.
Yeah.
And that's what I mean by like, well, in all of the above approach is probably the most appropriate for most
But
people.
there's like a safety net about it, right?
With the
Safe.
IUL, exactly,
Yeah.
because you have the floor, you can count on it. It can be more liquid, so to speak. And there's a lot of strategy around the fact that it's more liquid. So I think there's some pretty big benefits. Speaking of performance, the question in here is any concerns that historically IULs have not performed? Um, that's actually kind of a surprising question because when I look back at the book of business that we've written over the past 10 or 15 years, I would say 95% of the time, the original illustration has a lower projection than where they're actually at. So surprisingly, these policies have actually overperformed. So I'm not, if you want to email me your experience, but in our experience, if somebody sticks to the plan,
Yeah.
they're going to succeed, which sort of leads into one of your later questions, but
That's a really good
I'll
selling point, but we'll hold
yeah,
it.
I'll hold on to that for a little bit.
All right. Well, my next question was kind of who is a LIRP a good fit for? Is there anyone who just really should avoid it? Like, there's no point in certain people having it. Who's the target market?
That's a really good question. And the answer, there's a couple of answers and they're all, I think, correct. But the basic target, if you're like looking at high level, is, high income earners, people who are maybe looking for other places to put tax advantaged money. You have business owners, they might not want to set up a qualified plan because of the expenses. You have people that maybe cannot put any more money into their Roth plans, and so they're looking for other tax-free options. If you're concerned about future tax rates, is basically what I'm saying. I mean, I don't know if a lot of people put a lot of thought into that, but they probably should.
And that's their advisor's, job to do that and bring it to their attention.
Exactly. And one of the things that we at Advisors Resource Company do is we put together a presentation that helps demonstrate why they should be concerned about it, because I think they should.
Right.
And I'll show that
it later.
maybe a little bit.
Yeah.
Yeah, I'm just teasing that one. And then finally, if somebody wants insurance, like if you're going to buy insurance, the way that I look at it is if you're going to be like, let's say, you run into a young person and they're saying, you know what, I've got a couple kids, I need to buy some term insurance. Well, if you're going to buy the term insurance, why not get the sort of Roth account with it? Why not get the tax advantages of the cash value insurance? You know what I mean?
Yeah.
So that's an easy one to say, well, you should consider this.
Yeah.
Yeah, I'm not saying like everybody out there should have an IUL, but what I'm saying is if they have the budget, they're setting aside enough money. If they have the savings time is probably about 10 years. Like if you can wait 10 years to take money out, and you can fund it for at least 3 to 5 years, then this is probably a fit for you.
That seems like it'd be a pretty wide, like a lot of people can do that, you know?
Right. Now, the other thing about this is, and this is my personal opinion, some people maybe think I'm wrong, but I don't really care. The bottom line is you got to really think about what you want in your business, right? So if a client comes to you and says, I want to put $50 a month into an IUL, I would really think of, I would really,
Okay.
what I mean about this is what I would do is I would really think about that sale, because you will get paid on that, and you'll earn a commission, whatever. And the client will probably be better off. But the problem is, if you're going to do a good job, you're going to have to service that. And that's not a lot of you didn't make a lot off of it. So
I didn't even know do people do that?
I don't know.
Okay.
That's just an example.
Okay.
I mean, I try to target.
I guess sign me up.
I try to target somewhere around 1,000 a month. So like if somebody's willing to put 1,000 a month in, that's probably like a good base level. It's going to give them a nice amount of insurance. It's I hate to say worth it, but I think you've got to really think about your time, and are you going to do that person justice? Are you going to be there for them in the future when you made
almost no money?
Yeah, a couple $100, you barely paid for gas to get there.
It's
You know what I mean?
Balancing act between wanting to help them and helping yourself. So
yeah, and it's not even necessarily helping yourself. It's like thinking about how you're going to run your business in the future is what I mean by that. Like you should really think about that before you put on $550 a month policies. And then, okay, well, if you're doing a good job, you're doing reviews with these people. Are you really going to do reviews with all those people? I don't think so.
Understandable.
So anyways, I got off on a little bit of a tangent.
Questions at this time?
Let's see, that might be the same one. I didn't clear
just
them
kinda
out.
answer,
Yeah,
okay.
let's clear those out.
Okay, well, yeah, thank you
Maybe I
for
didn't
that.
clear those out. All right, got those.
All right,
So,
that pretty much sums up.
that's all I gotta
Okay,
say about
got
that. I
it.
mean, I could keep talking, but maybe no one cares anymore, so.
No, that's okay. We'll go ahead and move on.
So,
So, I mean, how can advisors go about handling the cost objection? So a lot of people think it's very expensive. I mean, I guess supposedly it's only 50 a month. Just kidding. But I mean, realistically, people do think it's so expensive. And so how can advisors go about taking that question on?
it's a really good question, Maddie, and there are costs of insurance. There are COIs, there are upfront costs of doing these policies. And I think it's just objection handling when you get down to it. I mean, that is an objection and it is a valid objection. But if you do 3 things, number one, you got to set it up properly in the beginning, right? You got to do a minimum or close to minimum, what's known as minimum non-MEC death benefit. So in other words, like when I did a policy on myself, a year or 2 ago, for like a death benefit and premium ratio, you've got to get those two close together, like the maximum premium and how much the client's putting in, and then the amount of death benefit. You know what I mean?
Yeah.
So like I'm thinking of the last one that I'm trying to come up with an example off the top of my head, and like on a 35-year-old, a $500,000 death benefit might be appropriate for 1,000 a month. So that's like kind of the scale that you're looking at, and you really need to target maximally funded. So that's number one. And what that does is it keeps the cost down, because the costs are exactly correlated 1-to-1 on the death benefit. So the lower you get the death benefit down, the less the cost is.
Okay.
So that's the first thing. Now, what I think you should also do is I think you should work with someone that's going to put something like this together for you. And I'm going to share the screen really quick, and hopefully I don't screw this up. So let's share the screen. And I think this answers the cost question, right? So when you do the analysis, the cost of insurance inside the policy is less than the tax you would pay in any other investment vehicle. Now, what you're looking at right here is a 45-year-old, and they're putting in 2,000 a month. And then we just calculated out the income starting at age 66 to 100. And then we compare it to a taxable investment account, a tax deferred account, which is an annuity, and then the qualified plan. And so what you see here visually is that after you account for taxes, the insurance actually is able to take out more. And that's because the COIs, or the cost of insurance, or the
Mm.
internal fees and expenses.
Mhm.
And fees is like such a dirty word in the finance,
Yeah.
like
Yeah.
fees, like it
Oh,
sounds
I
so
know.
bad.
Yeah, what are your fees?
Yeah,
Yeah,
exactly.
gotcha.
But the fees are less than the fee that the government is charging you for having a not a taxable investment, right?
Right.
And you could actually, I've never tried to say it that way to a client, but I guess that's just one of those things that might be a good way to position it.
Mm.
So you need to, if you're an advisor, you need to work with somebody that can prepare that type of presentation for you, and so forth. I'll try to answer that later because that's a little bit of a long one. So anyways, that's how I would handle the objection. You need to
Okay.
work with a intermediary, BGA, whatever the heck you want to call us,
Mhm.
IMO, FMO, that can provide that type of presentation for you, because I think that automatically handles that objection. Because whenever you bring up permanent life insurance, the client is thinking, well, Dave Ramsey said it was too expensive,
Dave
or
Ramsey.
yeah,
Okay.
or whatever,
Uh,
like whole life is expensive, and we're not even talking about whole life here. So I hope that answers your question.
It
I think
does.
that
It
does.
does. Yeah. Okay. So moving on, what about like returns? So how do LIRPs compare to other investments return wise?
That's a really good question, and I think that previous presentation does a pretty decent
Right.
job. I'll address the return aspect of it first. And returns are a tough thing, right? Because I could pick a 10-year period in the stock market where an index product's going to dramatically outperform, the stock market. Like if I invested my Roth IRA in the stock market, I could pick a 10-year period where IUL beats it by a long
Okay.
shot,
Okay.
right?
Yeah.
Conversely, I could pick one that, the stock market blows the IUL out of the water. I mean, just think of the last 5 years, right?
Mhm.
So it's a bit of like an apples and oranges thing, because you're talking about something that has no risk versus, the risk of a 40 or 50% downturn, right? I mean, like,
Mhm.
are you comfortable with even taking that sort of risk? Is that even appropriate? And even if it is appropriate, shouldn't you allocate some of it to some of your money, like some of your net worth, into something that is purely liquid, like an
Mm.
IUL, and has like the downside protection?
Right. It's safe.
Exactly. Yeah, exactly
Okay.
that. So, and I'm not like trying to say this is like the best thing ever. I mean, I
Mhm.
think they're good. It's a good tool. It's like a hammer's a good tool, but it's not very good for taking out screws, right?
Mhm. Yeah.
So I think I think the performance is an important question, and it is on the back of the minds of the client. Now, again, I will go back to handling objections, which maybe that's like not exactly the right word, really handling a client's concerns with this strategy.
Well, they just want to make sure it's right for them. And so just an
Exactly.
easy way to show them it could be a good choice.
Exactly. And I will go back to this presentation and say, look, this is one of the ways to demonstrate that an IUL has high performance, or a LIRP has high performance. But I think this is even better, because I
Okay.
like this, because I'm in love with my own work. But part of what we do here is we also, I don't know if you guys can see this down here at the bottom. I'll sort of highlight it. Down here at the bottom, we say, okay, if your taxable investment were to match the income on the life insurance, you would have to earn 9.7 every year in the taxable investment.
Mhm.
And most people, like, that would be a fantastic return on, like, a market portfolio, right? Same with the others. I mean, the others like the annuity is going to be a little bit higher, and the qualified plan is going to be the closest to the life insurance, because we're assuming the same tax rate today as in the future.
Mhm.
But the point of what I'm saying here is, even though your returns may be lower in an IUL, to match the IUL, you're going to have to be much more
It'd have to
aggressive.
be like the best scenario.
Exactly.
Okay.
Exactly. And I think the question is, if you're sitting across the table from a prospect, is that realistic? Again, I'm a life insurance guy. I got a ton of life insurance, got a ton of IULs, I got all this crap. I also have a lot of money invested in the stock market.
Mhm.
I think a balanced approach is the most appropriate. Anybody out there that says you should put all your money in life insurance is an idiot,
You're
right?
right.
I mean, that's like just crazy, but should
You're
you
no
put,
idiot. So you wouldn't say
no,
that.
I would never say that. But should you put some in it? I mean, I think it's a viable option if you're attracted to these types of features. So, um, I think that sort of answers the return
I mean, that's
question,
just a
right?
great graph that everyone should have
I think it
handy.
is. I think that is a good example
Mhm.
of that. So,
Mhm.
anyways, yeah, I hope that
Okay.
helps.
Yeah, do we have like a real life example to share with
Yeah.
everybody?
So
Okay.
what we've been looking at on the screen is, but let me just take a scenario that this isn't the exact scenario, but it's very similar to a case that I closed recently.
Okay.
And basically, 30-year-old, I'm sorry, 45-year-old business owner. This business owner had, I think, maybe 2 employees and maybe one part-time person. So, relatively small business, but
Mhm.
doing well, doing really well. In fact, they had high income. And so they wanted to set up a retirement plan because everybody thinks they should have a retirement plan. You probably should. You probably should be setting aside money, right, on a regular basis.
Yeah.
So we looked at the 401k, we talked numbers, and it was like, okay, they're comfortable setting aside roughly $30,000. We compared that to doing the 401k, which they would have had to put some money in for their other employees and so forth. Now, this particular client may still end up doing a qualified plan just as an employee benefit, which is great. I think if
Right.
you're going to do a qualified plan, do it for the employee benefit. Don't do it. We have a 401k, right?
Mhm.
Do it because you want to do it as an employee benefit.
Right.
So anyways, this person, we ran an illustration. We put about 30,000 into it over a 20-year period. We're targeting 65. I guess nobody really knows why everybody picks 65. It just seems right.
Yeah,
But
it seems old enough.
I don't know if this person specifically, I mean, I don't think they had really any idea. But anyways, assuming a really a conservative rate based on the floor and the cap of the policy,
Mhm.
this client can take out approximately 80,000 a year
Okay.
in retirement. And what's the best part about this? This particular client has a couple kids, a spouse, and they got the death benefit coverage as well.
Mhm.
Now, is it enough death benefit for their family? No, we did supplement with some term because it would be very hard to do an overfunded policy for all the coverage you needed.
Mhm.
I can't recall the exact amount of term that we did, but we did some amount. And as you can see here, and by the way, the sample I've been using the whole time.
Yeah.
Kind of teed this one up, I guess. So the cool thing about this is if you look here, their cash value by age 65 is roughly 800,000. Their death benefit at 85 at 65 is roughly 1.1 million. And the initial death benefit, if I can scroll down because I don't remember it, was just under 400,000.
Where's that?
So it's right here.
Okay.
And I'm sorry, I got that wrong. It was 24,000 of premium. It wasn't, it was 2,000 a month. It wasn't the
2,000 a month.
30,000. I
That's
don't know why
correct.
I had 30,000 in my mind,
Okay.
but 2,000 a month rather than
Mhm.
the 30,000.
Yeah, and if anyone wants to look at this, we can send it to them afterwards. If you just reach out to us, we can share this with people, right?
Yeah,
Okay.
yeah, that would be fine. And then furthermore, one other thing that I think was really cool that we show people in this presentation, because this is a long presentation, I don't intend to go over it all, but I don't know if anybody can guess what this graph is.
I can't.
It's not the stock market. This is the history of the highest marginal tax rates.
Oh,
Is
got
what
it.
this is. So
Okay.
speaking towards that, where our tax is going to be in the future and some strategies around mitigating taxes in retirement, I think is an interesting offer for your clients.
It is.
So I'll stop
It is.
sharing that for now.
Yeah, sure. So, if someone's interested excuse me, if someone's interested in exploring a LIRP, what should they do next?
Well, really, you should work with someone who truly understands how to set up these policies.
Right.
Most people should know how to run an illustration properly, but you'd be surprised at the stuff that we see come through.
Really?
And Yeah, and you just see things that aren't optimized, right?
Okay.
And maybe it's optimized to for compensation, which
Mm,
kind of is what it is. But if you want to do the best job for your client, you got to set it up right. You got to work with the right people. And I think that's most important. So
yeah.
picking your agency, BGA, whatever you want to call it, intermediary, IMO, I've heard it all. So I don't really
Just to
know
get someone that does it right.
exactly. Secondarily, you're going to want to have a presentation that shows all the points that we just covered. We have that presentation. You should work with somebody that has a presentation like that.
Mhm.
Furthermore, you want to work with somebody that can keep track of the policies for you after they've gone in force.
Yeah,
So
policy management.
if you're not going back to your old clients and reviewing policies with them, you're missing out on uh thousands of dollars of business. And I'll give you like a quick example. This has nothing to do with IULs, but my wife, when she got into the business, I got into business with my wife, of course. So,
Okay.
anyways,
Yeah.
she's now at home with the kids. And so, anyways, I took over her book of business, whatever, 6, 7 years ago.
Mm.
And so I called on one of her old clients, business owner,
Mhm.
and called on him to review his policy.
Sure.
And he said, "Wow, it's a coincidence that you would call because I'm just today I'm having my PNC agent quote. It was something. It ended up being like 35, 36 million in total coverage for a buy sell agreement."
Are you saying she fumbled her client?
Well, what I'm saying
Okay.
is it's lucky that I took over the reviews on that.
Yeah.
She was out of the business, so I'm not blaming her, but
Uh,
just by calling on this guy, we got this opportunity at these
right. We've
policies.
talked about this before about how just a phone call can mean so much to people and
I know. And so
saves their
anyways,
time.
so I guess my whole overall point with that is our firm, Advisors Resource Company, we help keep track of the enforced policies. We have a system that agents that we work with have access to where they can access those policies. So I think that's incredibly important.
Right. Yeah. So I think we're about a little short on time. We want to look at those questions. See if
Yeah,
we
let's
can
check out the
cover.
questions. Um, let's see. There are many insurance terminology or jargon such as LIRP, infinite banking, be your own bank. So this question is basically centered around IUL versus whole life, and that is a fairly long discussion, and I could have that discussion, but the
Mhm.
basis of it is number one, whole life uses cash value accumulation testing for the MEC testing,
Mhm.
and universal life can use guideline premium testing. And the material difference between those is so huge, and it makes the whole life a terrible vehicle for distributions.
Okay.
So if you do a whole life and you're going to do distributions, it's that's I it doesn't work because there's a fundamental difference. And I mean, I could go into more details, but that's the basic. And if you want to have that discussion
Yeah. Reach out
further,
to us
yeah,
and we can
reach
schedule
out.
a private
Exactly.
meeting. Yeah.
Exactly. I don't know that I want to go further on that. So the rest of the questions are just simply asking us about the presentation. Feel free to shoot us an email, shoot me an email. I intended to have a slide with my email on here, but I don't have that. So our phone number is 972-338-9655. My extension is 102. Feel free to call me. My email address, you know what? I'll put it in the chat. How about that?
Yep.
It's just jordan.pence@advisors-resource.com. Surely you've got a lot of marketing emails
Yeah.
from us if you landed on this podcast.
Yes. All the emails come from him, so you can reply back to those, but they actually go to
Hopefully I
me.
spelled it all right, but there's our email address. So
Yep.
if there's any other questions, I'd be happy to answer those. Chat is disabled. Okay. Well, I think
Oh, I can't go to everyone.
maybe. Let's see here. Okay, that's available. All right.
Mhm.
Feel free to ask any more questions. Maddie, I don't know if you have anything else to add,
Uh,
but
Let me see. I think that pretty much sums it up. We try to do these every 2 weeks or so, and the invite to our next one is always going to be on our website. And then additionally, if you had to cut out early or something, we post them so you can always go back and look at old ones.
Yeah, the only other thing that I will add is like if you really are going to take action on this, what I tell like almost everybody that we work with is, well, why don't you think about the top 5 clients that you have, right? Like think about those people. And if you know their income level, even better, but think about your top 5 clients and let's put together a proposal for them. Let's show them something. I mean, the only other thing that I would do is if I'm selling insurance and I actually do this, somebody calls up and says, "Hey, I want to buy some life insurance," and they say they want $1 million. Well, I show them, okay, here's term. Here's just like a protection product to last the rest of your life. And look, here's an overfunded IUL. And I sort of, you have an idea of like, how much somebody makes.
Right. I mean, obviously you should.
Like you should have like,
advisors.
yeah, exactly. You should have some idea or at least be in the ballpark. And if you have that, I will usually go off 10%. So like if somebody makes 300,000, I'll show them a $30,000 premium.
Just show them the possibilities.
Yeah,
They just don't know unless you tell them.
exactly. So we got another question. What software are you using to run our illustrations? That's a fantastic question. Our firm, we've developed this software in-house. So this is something that we developed ourselves. Um, it's, it's based on what we found advisors wanted in their presentations. We brand it all to the advisors. I don't need to promote Advisors Resource Company. We need to promote you.
Yeah, it's going to be your logo, your colors. It's going to be tailored to your client's demographic. So
it's something that we've developed in-house. So hopefully that answers your question. And it's something that you can, if you work with us, you can access. So feel free to reach out if you want more information on that, right?
Yeah, of course.
And then just some other, I think I answered the phone number question. I think that's about it.
Yeah.
We've got recordings on our website. I guess if you want to check that out, that's fine. And that's about it, I suppose. Let's see, I need to clear these all out. Awesome. Well, hope you found that interesting. Hopefully you learned a lot and hopefully everybody else enjoyed it. I think there's just a huge opportunity with working with individuals and business owners out there with these types of strategies. They're so simple and they're not that complicated and so forth. So anyways, feel free to reach out and look forward to seeing everybody and talking to everybody.
All right. Thanks, everyone.
Yep.